Yeah. साहिल ही स्टार्ट कर दीजिए.
Okay, thank you very much. So today we all are here for the webinar on the topic ESOP. I am not a product of my circumstances. I am a product of my decisions. And today we have with us the seasoned, what I can say, seasoned speaker and seasoned expert on this topic, Mr. S.P. Singh sir, who is ex-IRS. So I will take a chance to formally introduce Mr. S.P. Singh sir. S.P. Singh sir was with the Indian Revenue Service for more than 2 decades. He had various positions, including Director of Income Tax, International Taxation, and Commissioner of Income Tax. He participated in negotiation of various tax treaties with the country with more than 30 countries and took part in many mutual agreement procedures. S.P. Singh sir was with Deloitte also for more than a decade, where he led various initiatives. He has represented India in several international conferences and presented many papers there also. He was a member of the expert group on transfer pricing constituted by the Ministry of Finance for drafting the transfer pricing regulations also. SP sir is regular. SP is presently a senior advisor to Institute of Chartered Accountants of India, and we are blessed to have such senior experts on our panel who always guide us and give us a way to move ahead. SP sir is a regular faculty with the National Academy of Direct Taxes, ICI, and IM Lucknow. SP sir has been named by Euronomy, Euromoney, and Legal Media's Guide among the world leading transfer pricing advisors, and International Tax Review has recognized him as one of the global leaders in tax litigation for 2015, 16, and 17, and also leading TP expert for 14, 15, 16, 17. I think there is an n number of achievements that Sir achieved during his complete tenure, and I feel privileged to welcome such an speaker today in this webinar, Mr. S.P. Singh, sir. Over to you, sir. Thank you for joining us.
Thank you, Sahil, for such a long and nice introduction. I'm privileged to be present in this webinar along with Rujita and you, Sahil. It will be nice to hear, final points on the taxation of ESOP. Friends, good evening and welcome to this webinar on the tax implication of ESOP, an initiative by ICAI. And it's always a privilege for me to be present on this panel. Friends, you must have heard, recently you might have read that there was an order or, the direction from the Reserve Bank of India, which said basically that if any company wants to issue ESOP to a citizen who is located in a country with land border with India, then it cannot do that in a routine manner or an automatic approval route, but has to go to the government of India. And it has to be in accordance with Press Note 3. So, friends, I will just talk very briefly about what is Press Note and then what is Press Note 3 and a few words about ESOP, and then I will hand over to Rujita to take us through, all these aspects in a more detailed manner. If you look at Press Note, it is very much like circular or instruction in your income tax. So through the income tax, through the circulars instructions, the government clarifies various provisions of Income Tax Act and related acts. Through Press Note, the government clarifies the position in respect of the regulation regarding, foreign investment, technical flows, and monitoring the industrial development. All this started happening when India became, moved on to economic liberalization or making our economy, our borders free for investment, both ways, from India and to India. And as you would expect, investments are definitely welcome in India because if you want to grow, you need investment. There can be investment through the internal sources, but there has to be investment through external sources also, which bring in several benefits. But all investments are not good for the country. And the nation, the administration need to come into play whenever they want to restrict the investments which may not be good for the country. And this is done through the press note. And the press note 3, which was issued in 2020, basically said that somebody who is citizen of a country which has the land border with India, then it have to come, they can make the investment only through the government rule. This was in 2020. Now its scope is widened, and it is covering ESOP also. So that makes ESOP very important. So one apprehension may be that through the route of ESOP, it is possible that the ownership in an Indian company can be shifted and may be shifted to a location, to a country which may not be very friendly, or which we may not like to have that. So what is ESOP? ESOP is basically an employee stock option, and it was defined in subsection 37 of section 2 of the Companies Act. And it has 4 stages: the grant of options, vesting of options, exercise of option, and finally sale of shares. So ESOP is basically making available or making employees entitled to have shareholding in the company, which the main purpose is that it takes the employee's interest and the company's interest and merges that, so that employees become very dedicated to the company or loyal to the company, because the profitability of the company makes them more profitable. That's quite fine. There is no tax issue in the first 2 stages, that is the grant of option and the vesting. But there are tax issues in exercise of options, and obviously in the sale of shares. All the litigation relating to ESOP, like any other tax matter, there are a lot of litigation. And like any other tax issue, the litigation starts from the basic fact, the characterization. So, what is the nature of the payment which is made to the employees? Is it capital? Is it revenue? If it is revenue, then is it in the nature of perquisite or any other income? So that is so far as the characterization is concerned. Rujita will take us through two very, very important decisions of Delhi High Court and Madras High Court, and which do not talk, on the same line, but have different issues and rather opposite conclusions. But it will be nice to hear why do they differ and where they do they differ. The second aspect of litigation is the valuation aspect. Which value to be taken, whether the face value or face market value. So there are, decisions on that. The Delhi High Court has come up and said that it is the face value which is important. Now it means, the conclusion or the inference which we can draw from my talk just now is that whenever anybody, any company or any employee is planning for the ESOP, they must be very much aware. They should look at the various aspects of taxation and should not land themselves in trap or the bobby traps, I would say. So it has to uh, right from the beginning, at the planning stage itself, one must be aware of how it is being done, what are the issues which may arise. The problem becomes more complex if more than one country is involved. If the issuing company is in India and the recipient is outside, then both should look at the taxation issues. So, this being so, the taxpayer or the employees must declare their receipt in a very, very transparent way, and so the company should do it. I'm sure that the speakers today, Rujita and Shahil, will be, assisting, will unravel or make the complex issue very, very simple for us to understand, and use that uh, for the purpose of planning and the necessary steps one should take for an efficient plan to minimize the tax burden. I'm sure we all are going to be very much benefited at the end of today's webcast. Over to you, Sahil.
Thank you very much, sir, for your deliberation. It's been pleasure to have you on this webinar. Thank you once again from on behalf of the Institute of Chartered Accountants of India and the members present there. So now it's time to welcome our today's speaker, CA Rutuja Soni ma'am. So for a formal introduction, Rutuja Soni ma'am is a qualified chartered accountant with over 8 years of professional experience in providing business restructuring advisory services. She specializes in FEMA advisory, cross-border transaction advisory, developing tax-efficient compliant business structures, succession planning of HNIs, tax due diligence, deal acquisition, and salary restructuring. She has experience in advising the clients on matters relating to domestic and international taxation, including exchange control regulations, SEBI regulations, and the corporate law. She is also experienced in litigation under Indian domestic direct tax laws and has appeared before the tax authorities for various scrutiny assessments, income tax refund applications, and many more. So she is also the member of Chamber of Tax Consultants and Domestic Tax and International Tax Study Circle and FEMA Study Circles. She has contributed several articles on various complex direct tax law in non-tax journals and regular writer for international publications, international tax review, and assisted in making representation before regulatory bodies on important tax and regulatory issues. Currently, under Hethav's leadership in Indian taxation, KNM India is ranked as Tier 3 tax firm of the year. Rutuja as an individual has been nominated as a corporate tax rising star at the 20th annual ITR Asia Specific Tax Award. So she is also a regular speaker at Tax Sutra events and continuously contributing to the OECD in providing recommendations on Pillar 1 and Pillar 2 public consultation documents from last 3 years. I think the experience she carries was immense, and we all should be benefited at large today. So now let's welcome our today's speaker, C. Rutuja Soni ma'am. Welcome, ma'am. Over to you.
Thank you so much, Sahil and SP sir, for such a warm welcome. And good evening to everyone, all of the friends. I think ESOP is such a matter very close to everyone's heart, because day in, day out, we are having one or another advisories coming up, the compliance issues coming up for the employee stock options. So here I'll present it today, the session on the ESOP. I'm sharing my screen. Just a moment. I hope the screen is visible to all of you. So coming up, what do you mean by ESOP? As SP sir rightly mentioned, the ESOP stands for the Employee Stock Option Plan. Basically, what happens is, in order to motivate and align the interest of employees with the interest of companies, its shareholders and the companies may often to motivate the employees, they issue the employee stock option plan or the sweat equity plan. And under the ESOP, the employees basically obtain the right to purchase the specified number of shares at a predetermined price at a future date. Maybe the future date is fixed, or it may be determined on the basis of certain corporate events or the liquidity event, I would say. And after that expiry of that event, the exercising can happen from the employees to obtain these shares. So basically, normally the employee ownership programs may run into different plans are circulated by the employees. They basically provide the opportunities to subscribe the shares. Sometimes the plans are also cash settled plans. It is not necessary that all the ESOP plans will be equity settled plans where employees will ultimately get the shares of the companies. But the major scenario would be the company where they want to involve employees in the entire manufacturing of their growth scheme. And because of that, the company often grants these options to the employees. As SP sir already given the little brief about the granting, vesting, and exercising, I would take it ahead to explain what you mean by grant, what do you mean by vesting of the options, and how much time period normally has for the vesting depends on the options or the ESOP plan. And on fulfillment of these certain conditions, the options which are granted are vested over the period of the vesting. The employees, they do exercise the vested options as per the terms of the scheme on fulfillment and attainment of the conditions, and on exercise these shares are allotted to employees. If the ESOP plan says about the cash settlement, then at the on the exercising date, there is a cash movement or the cash flow which happens from the company to employees, and these are cash settled. So the different options are there just to promote the employees on overall basis. So why ESOPs are given basically? So as we just discussed, there is an opportunity to become an owner of the company. When you feel that you are the part of the company, the employees will they will be motivated to make their employment services more productive and more efficient towards the growth of the company. So there is a chance of the witness that the company's growth and the profits which company will have in the future, you will be witnessing that, you will be part of it, and part of the profits will also come back as a form of the ESOPs. So this basically provides the entire entrepreneurship platform for the employees to be a part of the company's overall shareholding. Now coming to the technical insights of the parts of the ESOPs. So there are basically four parts of the ESOPs. One is the grant of the options. What do you mean by grant? Basically, grant is a event where the employee is offered to a specific number of options to subscribe to the shares of the company. Whether any right is associated at the time of grant? No. Ideally, the grant is just you have been given a number of options as a grant. However, on attainment of the fulfillment of the condition itself, that right will be given to you. So the basically right is given when the vesting happens. So next condition is the vesting of options. When the vesting happens, it's a basically process where there is a right being given to employees to own the shares, and that right is only given to employee to own the shares at a future date at a attainment of certain conditions at payment of the predetermined price. If these are cashless options, then there is no payment at a future date. Now, when it comes to exercise of options, so once the grant of options is done, there is a vesting period. Once vesting period is over, there it comes the exercising of the options. So the exercising period is usually defined in the ESOP plan, which the company is formulated. The ESOP scheme or the ESOP plan talks about when the exercising can happen. So it is basically a event where employees can convert the options which are vested in their hands into the shares of the company, or they can even settle them in the form of cash if the ESOP plan or ESOP scheme permits. And that happens at the agreed consideration amount. So that basically becomes a predetermined price. So just to give you a example, that for example, the exercising event can be where the company is having the liquidity event when company is going for IPO. So that can be the event where all the vested options as an employee in my hands, I can convert them into shares and sell them on the stock exchange post IPO. So that becomes the exercising option. It's basically a process. We already discussed about the exercising event. The exercising event can also be a time-based event as well as the performance-based event. It depends again on the formulation of the ESOP scheme and plan. Just to let you know, friends, that the plan and the scheme can be different for all the companies as per their choice and norms. So the conditions which they will give, it will be a favorable to that specific company or specific industry or sector. It may not be necessary that all the ESOP plans and schemes will be same. Those are usually, we have seen that in the practical life, those are always different. because those are catering to a certain number of people at an early stage of exercising of those shares to become the owners of the company. And certain companies give them as a motivation where exercising may happen at a later point of time. So it depends on how your ESOP plan and ESOP scheme of the company is formulated. Going ahead, how the ESOP mechanism basically works. So once the grant of option, the options are granted to the employees. So basically you receive the right to have the option. Then there is a vesting period of 3 to 4 years, as we have seen in the past. Then the vesting of options happens. Basically you own the right to get the shares in the future date, at the future date. After the vesting of options, there is an exercising period which may depend on your time and performance conditions based. Once you exercise the option, then there is an allotment of shares, or there can be a cash settlement. And once the shares are allotted, employees may sell those shares depending if there are any conditions or restrictions attached to it. If there are no restrictions, the employee can sell the shares next day itself. So it depends on the discretion of the employee when to sell the shares. This is how the mechanism works. Now, just to give you the ESOP plan idea, how normally it happens. So let's take an example that at the end of the first year, there is an option which are granted to the eligible employees. The eligible employees definition can be different as per the plan. Normally, those are employees where they have already passed number of years, let's say 3 years or 5 years. It can also be depending on their performance rating. So after the options are granted, there is a vesting period of, in this example, it's 4 years. So at each year, there is a vesting of 10%, 20%, 30%, and 40% of the options. What happens, let's say, at the second year end? So basically, at the second year end, you have 30% of the total options vested, and there is a 70% of options which are unvested. So the right which you have received or earned is only restricted up to 30%. You have to serve your employment for the next 2 years to get those options vested. Otherwise, normally in the plans, those are the unvested options normally usually lapses when you leave the company or get terminated from the company. After the 4 years, after all the options have been vested, there is
Rutu, just a minute.
sorry,
I
sir.
just get I just get query from one two participants. I think the link of participants is not working or something like that. Please look into technical team. Please look into it. Now you can continue.
Sure. Thank you, sir. So the exercising event basically is the employees where they hold the options till the triggering of a liquidity event happens. We are coming to the point of how the liquidity events are being normally, forming a part of the ESOP plans. So as in the illustration given, Mr. A is eligible for 100 options. As per the plan, he will get 10 options at the first year end. He will get 30%, which are 30 options at the second year, 60 options at the third year, and 100 options by the fourth year. So by fourth year, all the options are vested. Now he has to wait for the exercising event to happen. Once exercising event or liquidity event happens, he can vest and exercise those shares. What do you mean by liquidity event? Normally, we have seen in the schemes, in the practical life, it works out very differently. When the exercising of the option happens, it's normally attached to the triggering liquidity event. One of the liquidity event, as I mentioned, is the IPO. So when a company goes and lists the shares of its on the stock exchange, there is a liquidity. There are public funds which are coming into the company. So that is one of the considered as a liquidity event. There can be another situation that there is a PEVC firm which funding the company, and there are particular, let's say, particular 20% of the shares have been funded by that PEVC. That can be considered as a liquidity event. So these liquidity events basically have to be mentioned in the ESOP scheme to trigger the exercising date or the exercising event. And once the liquidity event can also be, as I have mentioned here in the example, that it can be also 30 days from the signing of the financials. that can happen if the company's turnover exceeds 100 crore. So that is one of the conditions to trigger the exercising event. So that's how it happens that if the turnover targets are achieved by the company, and there is also a time period which existing employees are satisfied, all their vested options can be exercised at such a liquidity event. The next could be option of merger, demerger, spin-off, acquisition, or the change of control, amalgamation. There is a sale of shares. These are all considered as a corporate restructuring formats. And the corporate restructuring formats can also be one of the liquidity event which can trigger the exercising event. So, for example, the company is merging into another company, and there are options which are vested in the company, in the employees hands by the company. The exercising event will happen right after the merger or demerger, and it will depend on how the merger scheme is also formed, whether the employees will get the shares of the resulting company, or it will retain the majority of the voting powers of the existing company. So all that is depending on that. It majorly basically follows the approach of whether there is a change of the control, change of the share, majority of the shareholding of the company, that triggers the liquidity event. So, whether the one of the question can be that whether the change in the majority control can be considered as a liquidity event. Yes, it can be considered as a liquidity event. Whether the sale of the business through slum sale mechanism, can it be considered as a triggering event? Yes, it can also be considered as a triggering event, because when you sell the business, basically your entire value of the business is also getting moved from the company to another company. So that can also be considered as a liquidity event. Now, what are the types of options? Very relevant, because there are so many options available in the industry wide, not just countries wise, but other countries are also having very different options. There are some popular options in USA or Germany, in Japan. There are various options as per the laws of their own countries as well. But very basic and popular options I have considered here, which are the four options. The first option is a vanilla stock option. It's normally an extremely common, which is the employee stock option. So what happens here is the company basically grants option without any obligation to acquire a certain number of shares of the company. And generally it happens that there is a predetermined exercising price which a employee has to pay at a future date at a predetermined period to exercise these options. And these options, when you exercise, normally gets converted into shares of the company. So it's a very well plain vanilla stock options. The cashless options, these are very common options, generally in case of companies where foreign parent company are giving stock options to the employees of Indian subsidiary. We have seen that the cashless options are very common just to give incentivize employees or give a that motivation to the employees. They do not have any exercising price, and they give cashless options to these employees. These basically the options are granted at a predetermined event, and once that event happens, there is an exercising event which may be linked to the liquidity event. And these cashless options can also be equity or cash settled. So what happens is when the exercising event happens, the equity settle options gets converted into the shares of that foreign company. Or if these are cash settle options, then these cash settle options gets also converted into a number of basically shares into the fair market value as on that date, and that gets paid in the form of cash to and gets credited in the bank account of employees. So these are cash settle options. Generally, the cash settle options are also considered as a SAR, which is the stock appreciation rights, which is the next option. Basically, the phantom stock or the stock appreciation rights are usually performance based rights. So basically, an employee is given a notional units, and it is already predetermined that when, as and when the exercising event happens, the SARs, which are stock appreciation rights, are gets converted into a cash, and that cash is normally linked to the fair market value of the company, which is giving these SARs. And as on the date of the exercising event, these SARs are getting cash settled in the employees' books. And these can be also given to throughout all the globally. All these employees where SARs are given are these SARs are very common options in USA, Germany, and Japan, where they give SARs because it's the simplest option. There is no right given in the equity to these employees, and employees are already aware in the future they are going to get the cash settlement for these options. So these are the SARs and phantom stock. Going to the next, which are restricted stock units, very common in USA, not so common in India, but nowadays because there are cross borders structures, lots going on, there are RSUs being issued in India as well. The restricted stock units basically involve the grant of the shares as on the issue of the RSUs on day one. Basically, the RSUs, these are units which are given on day one. These are vested or on the completion of the vesting conditions. Once the vesting conditions are fulfilled by the employees, upfront they will get these RSUs, which will have some restrictions or a lock-in period. The restrictions and the lock-in period is that, for example, you cannot sell these units to any third party, or you cannot, you have to hold it for a certain period to vest over the period or exercising them over the period. So these RSUs are very common. There is a transfer of units happens on the upfront at the upfront level to these employees, but there is a provision which has been made that these can be reversed. There is a reverse vesting basically, which can happen in case of RSUs if those restrictions are not fulfilled by those employees and there is a breach of restriction of the lock-in period. So these are the basically types of the stock options. Going to the next one, I'll just give the examples, companies where they have done the ESOPs and the other types of ESOPs. So basically, as we explained, the vanilla plain stock options, Just Dial, India Mart, these companies have already done the ESOPs. It was a very basic and general phenomena. So employee stock options were very common. And that's why many other companies, along with these companies, have already given the stock options in the past. The next is the ESOP stock purchase plans. I'll just take a minute to explain what you mean by employee stock purchase plans. It is also called as a employee purchase plan, which is ESPP. What happens is basically companies give option to employees to purchase the shares at a discounted value. So there is just an offer made by a company to purchase those shares at a discounted price. This is also one of the called as one of the form of the ESOP. There is no need that it has to be vested, granted, and then given. So this is also one of the plans which are very common, have been followed by these companies, and they have given the employee stock purchase plans. The next is RSUs. So as I mentioned, when there is a grant of options and the vesting options happens, there is an underlying conditions that the company's target revenue should be met, the performance is to be met by the employees. And as and when the revenue and performance are met, the RSUs are vested upfront to the employees with certain restriction. If those conditions are fulfilled, those are exercised, and those options or the RSUs units gets vested over the period, and there is an allotment of shares which happens post RSUs. Infosys has, was one of the very first company to implement RSUs, and there are other companies like Wipro and Mphasis which has already been implementing RSUs very recently. The stock appreciation right, these are cash settled. So what happens in this example, basically there is let's say a share price as on the grant of the option 10. There is a vesting option happens over the period of vesting. At the exercising event, the share price of the exercise is 100 rupees. The difference between 100 and 10 is 90, which is the appreciation happens over the period of vesting. So this appreciation as on the date of exercising event can be settled in the form of cash or shares. Normally, stock appreciation rights are usually settled in cash. So basically, a 90 rupees per options will be given to employees as on the date of exercising. SARs have been implemented by many Indian companies. Some of the examples are given here, like Naukri, Mindtree, Kotak. They have implemented SARs in the past. Many other companies are also having SARs in common, because there they do not have to mandatorily give the equity form of settlement. There is a choice at the end of the company to give it in the form of cash. So their shareholding is not change later at the exercising event, but there is a cash settlement which happens. I'll just give a brief about the companies. There is a Rule 12 of the companies which has the criteria for the eligibility of the issuance of ESOPs by Indian company. So who are basically eligible to get the ESOPs? So there is a permanent employee of the company who has been working in India or outside of India are eligible. Then there is a director, whether the director is a full-time director or it's not, but excluding independent director. Basically, independent director is not eligible to get ESOPs as per the Companies Act. And there is an employee which is defined under the clauses, certain clauses. So for the subsidiary in India or outside of India, or the employees of holding company in India or outside of India, they are also eligible for the ESOPs. This is very relevant because their taxation, whether it is an employee or a director, and maybe your director is non-independent director, whether once the ESOPs are issued to them, how their taxation works is a very interesting phenomena. So it's very important to understand that the director and the employees are who are the eligible to get these ESOPs. Coming to the tax, so till now what we have just discussed is about the technical phenomena, how ESOPs works, what are the options of ESOPs. But very important and main object of our today's session is the tax implications on ESOPs. So there are two events when there are wherein there is a tax event in case of ESOPs in the hands of employees. One, at the time of exercising of the options. Once you exercise the options, you get the shares. And second event occurs when there is a sale of the shares of these ESOPs. So at the time of granting and vesting in India, there are no tax implications. We have seen in practical life that there are implications in other countries on granting and vesting of the shares as well. But in India, it happens only at the time of exercising of the shares. What is the salary or the compensation which triggers at the time of exercising event basically? So as on the date of exercise, the fair market value of the company and the predetermined price which is paid by the employee, the difference between them is taxable as your compensation or perquisite, and it is taxable under the head of salary. So how the fair market value is computed? Basically, the fair market value is computed as per the valuation report given by the merchant banker. There is a rule 1038 of the income tax rules, which determines the value for in case of an unlisted company to be given by the valuation report certified by the merchant banker, which is very close to the event of exercising, nearest to 180 days basically. However, in case of a listed companies, it is the average of the fair market value of as on the date of the exercising. And the fair market value is basically at the average of opening and closing of the fair market value on the recognized stock exchange. So the fair market value and the exercising price, these are the two major components to determine the value of the perquisite. Once you determine the value of perquisite, it is taxable at the slab rate wise in the hands of employees. And there is an obligation on employer to deduct the withholding under section 192 on such salary and perquisite income. Now the other part, which is the capital gains. So when, as and when you sell the shares of the company, the employee is basically taxed again on the capital gains. However, in order to avoid any double taxes, the cost of acquisition to determine the value of the gain or the capital gains amount is considered as a fair market value as on the date of exercising. Because the employee has already paid taxes at the time of exercising event, he doesn't have to pay taxes again at the time of capital gains. That's why the benefit is given that as and when you sell the shares of the company, the sales consideration amount is basically the fair market value as on the date of exercising is deducted from the sales consideration amount, and the difference is treated as a capital gains. Depending on the period of holding, for how many years you are holding the shares of listed or unlisted shares. So in case of a listed shares, it is 1 year. In case of unlisted shares, it's a 2 years period of holding. And depending on the period of holding, it will be a long-term or short-term capital gains. As I mentioned, the cost of acquisition will be a fair market value as on the date of exercising. To just give you an example how it works, let's take an example that the fair market value as on the of the shares as on the date of exercising is 100. There is a consideration paid by employee for acquiring the shares under the stock option plan, which is 10 rupees. Basically, this is nothing but an exercising price. So this is 10. The perquisite value, which is a triggering event for the tax implications in the hands of employees as on the date of exercising, is 90. So as on exercising date, the employee is taxable at 90 rupees per option and it has to be treated as a perquisite under the head salaries. It is taxable at the slab rate. Coming to the next point where there is a sale consideration happens, there is a sale of shares event happens. So as on the date of the sale of the shares, the sales consideration amount in this example is 150. We have to take the cost of acquisition as same as the fair market value of the shares, which would be as on the date of exercising, which is 100. So the difference between the sales consideration and the cost of acquisition 100 becomes 50, which can be treated as a long-term or short-term capital gain and taxable at the prescribed rates. So this is how the tax implications works in very common and normal scenario in India, when let's say Indian employees resident of India getting the ESOP options of Indian company, and he is getting taxed at these events. So this is very, very plain vanilla and basic tax implications which normally occurs in case of ESOP plans. Now, what are the ESOP issues? It's very important to understand the nuances which happens, and there are so many case laws on different topics of ESOPs which are coming up, which have already happened. There are Supreme Court case laws, there are High Court case laws which have already been, rulings are available. One of the issue, there are certain 3 issues which we are going to discuss. There are practical case studies and the recent rulings which we are discussing henceforth. The first issue which I would like to discuss is the relationship between employer and employee in case where there are foreign companies granting ESOPs to employees of Indian subsidiaries. Very common phenomena that there is a foreign parent entity granting ESOPs to employees of Indian subsidiaries. Though under the foreign exchange law, it is already permissible under the foreign exchange respective laws, which is non-debt instrument rules, where you, as an employee, you can get the shares of the foreign company. But for the tax purpose, because what tax implication says is you have to basically have the employer-employee relationship. Now, the question arises whether the employee of Indian subsidiary is actually having the employer-employee relationship with the foreign company, and that's why the rulings have occurred in the past. So there was a Microsoft Corporation USA AR ruling where the advance ruling, it was held that the benefit arising to the employee of the Indian subsidiary from this stock option is granted by US parent. It should be taxable in the Indian employee's hands as a salary. Basically, the principle was drawn as why you are getting the ESOPs. You are getting the ESOPs basically because the parent entity is not considering you as apart from different from your employees of the subsidiary companies. Its own employees and the subsidiary company's employees are treated at a same level, and they consider as a group level business. It's like one and the same business and one of the same company as a group company, and that's why lifting the corporate wheel, the AR held that it has to be treated as a salary. It cannot be treated as other source income or any other income. It has to be treated as a perquisite under the head of salary. So the AR ruling was also upheld in the case of tribunal case of Sumit Bhattacharya, which also relied on the Supreme Court case law of Devki Nandan Agarwal. Now, here it was a very much settled principle which was drawn that the employee-employee relationship is not just necessary that for income to get taxed as a salaries. So, very important principle they have drawn here, that it is not necessary that only formally or economically or legally you should have the employer-employee relationship. Any economical relationship between employer-employee can also consider for the income to be taxed under the income of salaries. So it is enough for an employee to earn any reward for the services it is rendering to the Indian subsidiary, and for which they are getting the options of the foreign company. So in this case, because the parent companies are recovering the benefits which are cross-charged by the subsidiary company. Ultimately, the subsidiaries are also working for the parent companies. They are supporting parent companies to grow their business. So ultimately, the employees of Indian subsidiaries are also considered at a very par level of employees of parent company. And that's why economical relationship should be looked at, and there should not be any legal employer-employee relationship to be considered for the purpose of income to be taxed as a salaries when there is a cross-border ESOPs. So this was one of the issue which was discussed. The second issues are related to taxation in case of SARS. Then there are other plans like sweat equity. We'll just discuss in 2 minutes on this. So whenever there are cash settled SARS, now as I mentioned already, in case of SARS, there is no basically equity mandatory equity settlement. There can be cash settlement. So when the company is obligated to pay something in cash, basis the valuation of the company as on the date of the exercising of these SARs, whether these cash payments are treated as salary or those should be treated as some other income. So again, the same tribunal decision in case of Sumit Bhattacharya, it was held that the benefit which is occurring to SAR, it has to be treated as a salary, because the ultimate getting the SARs allocated or granted to employees are because of their service of employment. The employment service are basically a triggering point you to get these SARs, and that's why it has to be treated as a salary in the year of redemption of these SARs. Similar to cash settlement, equity settlements also, whenever there is a equity settlement happens in case of SARS, so any difference which is payable by the employee towards getting these SARs should be deducted from the fair market value of these equity ESOPs or equity shares, and any difference between the two should be taxable as on the exercising event as a perquisite under section 1726 of the Indian Income Tax Act. Basically, 1726 is the perquisite. It talks about the definition of perquisite, which includes that any value of securities or state equity shares or shares allotted to the employees at a free of charge or at a concessional rate should be charged at the fair market value as a perquisite in the hands of the employees. Similar to SARS, in case of a sweat equity shares, now sweat equity shares is also very common phenomena. It can be also treated as an alternative to ESOPs. Not necessarily that it is a forming part of the ESOP plan, but generally sweat equity shares are given. These are the equity shares basically at given at a discounted value. So the value of perquisite is basically determined basis the fair market value again. And if any discounted value which is been paid by employees towards getting these sweat equity shares, then the price paid by these shares should be deducted from the value of the perquisite, and remaining will be taxable as salary. So this is the case of taxation in case of SARS and sweat equity. The third case, the third issue which I would like to discuss is where the ESOPs are given to non-employees and exercising of the options by legal heirs. Very important. Sometimes what happens is the ESOPs are vested already to the employees, but those before they exercise, they are no more, and the legal heirs basically ask for exercising of these options. So what happens in that case? Sometimes the ESOPs are given to directors which are not employees on payroll. So in that case, what happens? So as already I discussed that independent directors under Companies Act and SEBI regulations are not permitted to get any ESOPs. Non-independent directors who are in the basically capacity of getting these ESOPs, it normally treated them in their hands as a perquisite, but under the business income. So there is any benefit or perquisite given on exercising of the profession or business is normally taxed in the hands of the directors under section 28(4), because for them this is a business income because they are not on payroll, so it cannot be treated as a salary income there in their hands. So the entire value which is associated with them is basically deemed as a income and taxed as a business income. In other cases where the directors are not associated with the companies and they are not independent directors, maybe insignificant cases this may occur. But if the ESOPs are given to such directors where they are not associated with the business of the company and they are not on payroll of the company, then in that case it may be treated as for them as income from other sources. However, now in these cases where either the income is taxable under section 28(4) of the act or income is taxable as income from other sources, what would be the value of the ESOPs? That question may come up because the rule 3(8) it only talks in reference to section 17(2) of the Indian Income Tax Act, and 17(2) only talks about perquisite, which is under the head of salaries. It does not talk about any other scenario. And rule 3(8) is also given only restricted to read with the section 17(2). Therefore, the other rules or the valuation rules, can we take the purview of them? That is the question. So rule 11 UA, basically it talks about section 50 CA and 56 to 10, which are the income from other source sections, and 50 CA is basically for the capital gains. There is a rule 11 UA given where there is a adjusted book value is treated as a value of that particular shares or the company, or and that's how the equity per share value can be computed. Can we take that as a value for determining the value of the perquisite under section 28(4) or income from other sources? In this case is the real question. In many of the judicial precedents, people have taken other valuation rules. Somewhere they have taken 3(8), somewhere they have taken 11 UA, somewhere they have taken that there is no rule, so the entire perquisite is taxable as per normal scenario. If there is no value associated with it, then if any fair market value which can fetch them from the market, that value may become the value for the company. So that is the issue still under consideration. Another scenario is the exercising of the ESOPs by legal hair, where the exemption from. So basically, what happens is that there is a definition of property under Section 224. So the exemption is given from the definition of property if that is received under the inheritance or will, in case of it has been received by legal heirs of the deceased employee. Now, in that case, how this ESOPs basically works out, because the options are already vested in the hands of the employee, deceased employee, and those were not taxable because the taxable event did not occur by that time. Now, the taxable event is occurring in the hands of legal heir when they are exercising these vested options. Now, the right to exercise these vested options given to legal heirs, can it be treated as a capital asset? That is also one of the question. Can it be treated as a benefit occurring as an account of income from other sources? Because ultimately the legal hair is not associated with the company. There is no employer employee relationship between the legal hair and the company. So arguments have been placed differently in different rulings, and there it can it people have taken the view that it is an income from other sources, and if there is an exemption given that the property received under inheritance or will is not taxable under section 56 to 10. So the argument is very well taken in the past in a few of the tribunal rulings, where on account of inheritance or will, if they are getting such benefit, then it is exempt and it is not taxable in the hands of legal heirs of the deceased employee. So the next part is the reporting requirements, and then I'll take a pause of for 5 minutes. If there are any questions, would happy to address them. Reporting requirements in the hands of employees. Uh, I have seen in practical cases that many cases where employees of Indian subsidiaries are having ESOPs of foreign companies, they do not disclose any of these options in their Schedule FA, which is Foreign Asset Schedule. It is mandatory to disclose these options as and when they are exercised in the Schedule FA in their own income tax return filing. There is a lot of unawareness in this aspect, and there is a heavy penalty of up to 10 lakh rupees if you do not disclose your foreign assets in the Schedule FA of your income tax return. So as and when basically ESOPs are vested and employees are exercising them, if there is no exercising price, it can be mentioned at zero value. If there is a exercising price for these options, those can be mentioned at a value at which basically the exercising price was paid by individual employee. So the disclosure is very mandatory to be mentioned. People have questions that where the disclosure should be there, because there are so many parts to the foreign schedule FA. So in our experience, we have always advised all such employees that you should mention in Part D of Schedule FA, where the details of any other capital asset held at any time during the relevant accounting period should be given. And there is a lot of disclosure requirements, so it has to be very carefully given by each individual employee. Also, if there are certain details which are not understood, then one should refer to the ITR instructions to see whether there are any alternative wayouts to mention the required information. Before moving to the cross-border structure, I would like to pause. If there are any questions, happy to address them. Otherwise, we'll move to the next part. Sahil, can you just check if there are any questions? We can take those questions and then
Yes,
we'll move
sure.
to the next part. Thank you.
I request everyone, if you have any questions, then please put it in the chat box as well, so that we can take up there also.
I think if there are no questions, then I'll move to the next part.
No, just a minute. 6, 7
Sure,
questions
sir.
are seen in my report. Just it is opening.
Sure, sure.
Meanwhile, yeah. So Bharti Agarwal ma'am has asked, what about selling it in unlisted market if listing is not happening in near future? Means as the company has granted the ESOP to them and the company is not listed. So what should be the implications if the other person wants to sell in the unlisted market? I think the question is very clear from my end and to all the audience. So you can take it up.
Sure. So, if there are unlisted, basically shares which are granted to employees, and that the employee wants to basically sell in the market, as I understand. So, as a grant of options, you cannot sell in the market directly, because still granting and vesting, the options are in the form of stock options, and those are actually not converted into shares. So, as and when the exercising happens, for these options, then you actually, as an employee, you get the shares of, and those options are converted into shares. The ratio can be 1:1 for these options into shares. The ratio can be 2:1, depending on how the ESOP plan and ESOP scheme is formulated by the company. As and when the exercising happens, the employee is can sell this in the market, provided there are no restrictions given in the employee stock options plans. Sometimes it is given that there is a right of refusal, basically ROFR clause is given. Normally in ESOPs, we have seen that you have to take the permission and NOC from the company to sell to a third party, and there may be a possibility that in such case the company will buy those shares from you, because the company may not want any third party to become the shareholder of the company. So in such case, the employees will have to mandatorily sell to companies at a fair market price as on that date, or nearest to the date, as the clause, ROFR clause, has been placed in the employee stock option plan. Or if there are no such clause mentioned in the stock option plan or scheme, then employee is free to sell in the market.
Thank you very much, ma'am. So just to make everyone, it's a proud moment for us also. Nearly 300 people joined in this webinar across from all over India, and I'm seeing questions from Pune to Bangalore, Ahmedabad. Everyone is into it. Thank you very much for such a great response, and ma'am, we are thankful to you also that
That's great.
your webinar is going very good. So the next question we will take from Arnav Bhattacharya from Bangalore has asked how cash settlement works. Will subsidiary pays to holding company?
So I believe the question for cash settlement is basically holding company shares are issued to the employees of Indian subsidiary. And as and when the exercising event happens, the holding company should pay off these cash directly to the account of the employees. That how the technically it works. We have seen it practically that sometimes holding company gives the entire chunk to Indian subsidiary, and then Indian subsidiary remit them to the employees as a part of their salary income. On monthly basis, they give the salary. Along with that, they give the compensation, this payment of cash settlement also along with that. So that's how it works. However, there may be challenge under FEMA, where the holding company cannot give Indian subsidiary this kind of a payment, but bankers have accepted in the past, which we have seen. So technically, holding company has to pay. However, practically it works that Indian subsidiary pays out. I hope I answered the question.
Thank you, ma'am. So we'll take 1, 2 questions more, then we will continue our
Sure.
discussion. So Harshit from Ahmedabad is asked, in group company can a subsidiary one give ESOP to subsidiary two that have common holding company? Means the two subsidiaries having common holding company can issue ESOPs, yes or no? And what is the impact or what is the implication?
So normally it doesn't happen. I'll tell you the reason why it doesn't happen. The value creation happens at the holding company level. So employees will always be interested in the company where the maximum value is generated. The value generation, let's say, happens at both the subsidiaries level, both the India subsidiaries level, but ultimately it gets consolidated to your holding company level. So generally, we have not seen this case where the other fellow subsidiary is giving ESOPs to the fellow subsidiaries employees. However, technically, I believe it is possible as far as they are the related parties and a part of the same. In such case, the employer-employee relationship can be questioned because the case laws which we have just seen about Microsoft Corporation and Sumit Bhattacharya, those were pertaining to holding and subsidiary relationship, and they were not catering the two fellow subsidiary relationship. So in that case, that question may come up, but I believe the technicality, that should not be a problem.
Thank you, ma'am. So the next question asked by Meenakshi Kataria from Delhi. ESOPs are to be shown in detail of foreign equity under schedule foreign assets.
Yes. So we have seen both the cases. Right question. Where the foreign equity interest is also one of the part of Schedule FA, and where the basically equities are or options are converted into equity, then you can show there. However, we always mention and request the clients who are getting the ESOPs of holding companies to mention as and when they vest. At the time of vesting, the value may not be associated, but that time, as and when they vest, because there is a right given to them to get the shares or equity settlement happen at the future date. Obviously, there are restrictions and conditions, we believe, but in that case, the Part D is more relevant rather than the foreign equity. But correct, the answer is correct that it has to be mentioned in the foreign equity once it gets converted into shares of the foreign company.
Okay. We will take this last question.
Sure.
So it is asked by Jay Srivastav from Delhi. Ma'am, whether having ESOP requires disclosure or only when it is exercised?
No, so this I just mentioned. We always request the clients on conservative basis to mention ESOP options as a part of their Schedule FA as and when they vest. However, technically per se, because the exercising event is the tax triggering event and the first event for employees based out of India, even if you mention in Schedule FA, after the exercising event, still it should be okay in our view. But conservatively, we always mention that it should be mentioned in and disclosed in Schedule FA only after vesting of options occurs on year-on-year basis.
Okay. Thank you, ma'am. We will take last question
Sure.
from Lalit Ajmera from Mumbai. He's asking, it is quite common for companies to set up a trust exclusive for implementing ESOPs. So what are the tax implications in that case?
So normally we have seen employee welfare trust which are created for the purpose of ESOPs, and those are normally created where there are large number of employees, more than 1,000 employees, and this normally happens in case of a listed companies where the separate trust can be formed. In that trust case, because the trust is purely formed for the purpose of the company, so there is a employer-employee relationship can be built between the trust and the employees also, because the trust holds shares only for the benefit of employees in that case. And the trust is basically taxable as and when, all the ESOP expenditure, which normally is the difference between the value as on the date of granting of the options and the stock price of that option as on the date of grant. The difference between them is considered as a discounting of the ESOP, and that discount of ESOP is basically tax deductible expenditure. There is a issue in that which I'm going to cover later part of this presentation. But in that case, what happens is this particular discount, which is ESOP deductible expenditure, is allowed for the purpose of trust. any gain which happens and the net profits occurs in the books of trust is taxable in the hands of trust as a AOP. So there is no maximum marginal rate which is given because this is not created as a discretionary trust. This is a specific beneficially trust created for the purpose of employees. So it is normally taxed as AOP for the purpose of the tax.
Okay, ma'am. Thank you very much. Now requesting
just
you,
one thing
if you want
which
a
I would
break
like
of
to
5 minutes,
add.
you can.
I think
Hey.
SP sir wanted to speak. Yes, sir.
It's not a question, but basically, I mean, some aspect which need to be considered. You know, we all know that many foreign companies have Indian subsidiaries, which are on the cost plus basis. They provide, I
Yes.
mean, particularly in IT areas. And in that case, I mean, ESOP is, released by, or the system is there from the, the parent company. Now, the questions which have been arising, I mean, during the assessment as well as in the APA, is that whether that will constitute a part of the cost of the subsidiary on which the cost plus should be levied. So it is, something that the parent company pays to the employees of, the subsidiary, whether directly or indirectly, the two situations, Rajita, you mentioned. Then
Yes.
in that case, whether that element has to be taken into account for the purpose of computing, I mean, cost plus basis. That's that you can share your thought on that. There is no, I mean, firm, I mean, answer on that. That's something which is always debated. Yeah,
Yes.
Rajita.
Yes. So rightly mentioned, basically this is a transfer pricing scenario which you are right now dealing with, sir. What happens, and as rightly mentioned by you, that there is no confirmed or firmed answer, but there are case laws which are supporting favorable and adverse at both the levels. Basically, when there is a cost incurred by the Indian subsidiary to the extent of the expenditure on ESOP pertaining to employees of Indian subsidiary, which is basically allocated by the holding company. And that allocation mechanism is very important to understand for the deductibility of such expenditure in the books of Indian subsidiary. If it is the deductibility is basically happens on the over the period of vesting, and this expenditure is allocated by a holding company to the subsidiary company over the period of vesting, then basis the case laws which I'm going to take in the next part of this, it is deductible expenditure so far as revenue expenditure is concerned in the books of Indian subsidiary. Now, the moment it is deductible expenditure for the purpose of income tax, the question arises whether I should charge markup and form a part of my operating cost when there are captive unit service providers who are providing services to the holding company. And the definition of operating cost says that any cost which is incurred towards your employees are also should be forming part of this operating cost if you are providing a support service to your holding company, and that's why the markup should be charged. So there are case laws which determines and settle this basically this point of principle that the markup should be charged on such cost, considering this as a operating cost. Now take a scenario where the expenditure is just allotted to the company, but there is, and it is just for the book entry purpose. There is no actual payment which is going to happen from India to the holding company. In that case, there are scenarios where it is just considered as a cost in the books of Indian company and there is no markup charge on that. Because in such cases, the expenditure also may not be deductible expenditure because uh, it is just for the book entry purpose and there is no actual obligation by Indian subsidiary to make the payment to the holding company. So both the ends are basically possible. It depends on what is the arrangement between the holding and subsidiary entity, and then one has to take the view from the transfer pricing perspective on that.
Correct. Go ahead.
Yes, thank you, sir. So moving to the cross-border structure. So till now, what we were dealing with is just from the India ESOP perspective. Now, moving to the cross-border structure, there are two scenarios where the cross-border structure comes into the play. The first scenario given on your screen is the scenario where the foreign company grant options to the employees of Indian company. Here I'm just dealing with the tax law. So FEMA, I have not captured here in the interest of time. However, let's assume that under the FEMA, scenario 1 and scenario 2 are permitted. So we will not go to the implications under FEMA. Now, in this scenario where the options are granted to the employees of Indian company, we assume that the all employees are resident employees. Now, when the taxable event occurs in such case for the Indian employees, it is very common phenomena where Indian company is issuing ESOPs or granting ESOPs to the Indian employees, or foreign company granting options to the Indian employees of Indian subsidiary. At both the level, the taxable event is quite similar and same. The taxable event occurs at the same two events. One is at the exercising of the option or the allotment of shares, which is the perquisite at the time of exercising of the options, difference between the fair market value as on the date of exercising, and if any exercising price been paid by the employees, then that price should be deducted to arrive at a perquisite amount. The second event is the sale of ESOPs. So whenever there is a sale of the shares of such foreign companies shares by Indian employees, the sales consideration amount which is generated as on the day, on account of the sale of the shares, the fair market value as on the date of exercising of the option should be deducted from it to arrive at a capital gains. Depending on your period of holding, the capital gain will be short-term or long-term capital gains. So this is a quite, a plain vanilla scenario. The issues and all the nuances comes in the case of second scenario, where there is an Indian company. Consider that Indian company is a holding company, and Indian company is issuing ESOPs to the employees of foreign company. Now, in such case, what happens is Indian company issue options to the employees of foreign company. These employees may never render the services in India during the granting, vesting, and during the exercising period, or there can be a second case where employees have rendered services in India for certain number of days during the vesting period. So I have taken both the cases here. Case one is where such foreign employees have never rendered services in India during the vesting period and during the exercising period, and they are non-resident for the Indian tax purpose. The case two is where the employee have rendered services most of the time from outside of India, and only for certain number of days they have spent in India and during the vesting period. So, taking the tax implications in case of a case one, where employee have never rendered services in India. So technically what happens is the section 52B of the Indian income tax law says that if the income is accrued or arised in India or deemed to be accrued or arised in India in case of a non-resident, then it is taxable in India. And section 912 talks about the salary income which is received in India out of the services rendered in India. Now, there is a case law of Unni Krishnan which deals with this scenario, and it says that if technically any employee who has never rendered any services in India to the Indian parent company who are issuing the shares, then ideally in such scenario there should not be any income accrued in India or deemed to accrue or arise in India, and that's why it should not be taxable in India. However, this view is quite litigative, and there are contrary views also taken by the courts in India. Because what happens is there is a tax chargeability section of section 15B, which is the chargeability of salary section, and the section 5.2. Basically, section 5 talks about your scope of total income. Section 15 is a chargeability section for the salary. The ambiguity arises where it is considered that whether 5.2 will prevail over section 15 or section 15 will prevail over section 5. So there are case laws which courts have held that Section 15 is a chargeability section. Unless your income is chargeable to tax in India, the total scope should not come in the view. So Section 52B basically will come only if there is a Section 50, there is a income under Section 15A or 15B of the ITI. The important point to determine whether for these employees any income is taxable in India or not, there are two important points to take care. One is whether are there any services rendered in India, and whether there is employment exercised by such employee in India. If in both the cases the answer is no, ideally speaking, there should not be a case that these income should be taxable in India. Now, um, further, it can be argued that as there is an employer-employee relationship in the reverse scenario, it can also be said that the Indian parent company is giving ESOPs to foreign employees, employees who are, let's say, foreign subsidiaries employees. These are part of my own business, and so there is an employer-employee relationship, and in a way, these employees are providing services to the Indian parent entity, and that's why it should be taxed under the head of salaries. So the arguments have been placed in various scenarios, but then in such case, one can take the view under the respective double tax avoidance agreements, the DTAAs, between the two countries. Let's take a scenario of India USA. So in such case, the Article 15 or Article 16 respectively of DTAA, it talks about the dependent agent services. And this DTAA clearly brings out the position that if the remuneration is derived by a resident of a country where he has rendered the services, and such remuneration is paid also in the same country of residence, then it will be taxable only in the country of resident. It will not be taxable in the source country, basically, from where the ESOPs are, granted to such employees. So, by virtue of tax treaties, employee can take the benefit that per se the income will not be taxable in India. So, in Income Tax Act, the argument can be placed by both the scenarios, whether the income is taxable in India or not. But from the perspective of Article 15 or 16 of DTAA, definitely this can be said that such compensation income as on the date of exercising may not be taxable in India. But this is the first event. Now, the second event, when there is a sale of shares of Indian company, because the capital asset is belonging to India, and in India, basically, it is situated in India, the capital gains will definitely attract in the hands of the employees who are the foreign employees as a non-resident. And depending on the period of holding, those will be taxable in the hands of these non-resident employees as a capital gains. So only the compensation income has to be seen whether it is taxable in India or not. However, capital gains will always occur. And also usually most of the DTAAs, they talk about the capital gains article where they say that the domestic provisions of the respective countries will prevail in such cases. So in case of, let's say, in our example of India USA, it talks about that the capital gains provisions in India will prevail in such case, and that's why there will be a capital gains on sale of ESOP shares. So this is in case of first scenario. Coming to the second case, now employees who have rendered services in India for a certain number of days, we have practically seen most of the people falling under this part, because there are CEOs and CFOs who are traveling all over the world to grow the business, do certain activities, come for a certain number of days in India. Let's say they come for 30 days or 15 days in India for in the year. So basically, during the period of vesting, they are rendering services from India for certain number of days. So what happens in this scenario? So basically, when they are getting this right to acquire the shares during the vesting period, where they are rendering certain number of days in India, there is a ruling of Robert Arthur, which is the you can say a primarily ruling which deals with this situation, which talks that each country where the employment was exercised by such employee should get benefit out of these ESOP income, and the right to tax should be given to each country where employment has been exercised by such employee, and it will be given on the proportionate basis. So this right is given basis the proportion. Now, how the proportionate is decided? It is decided basis the number of days the employee is spending in that particular country. Let's say in India he spends for 15 days, then it will be computed basis his number of days stay during that vesting period, the number of options vested during that period because of the employment exercised by him from India, and those options are granted towards the during for the purpose of those vesting period. So all these conditions should be satisfied. The condition of that he has to spend that number of days in India for the particular during the vesting period. Then when he is exercising, he may be in India, he may be outside of India, but during that period he has to exercise and serve the company, the serve to the foreign company. In that case, it's not that he is coming for a vacation and just spending time here. If that is the situation, then there will be a litigation around it, whether during the vacation period he's serving and rendering any services to foreign company or not. Now, there is a short stay exemption which is given under Section 1066 of the Indian Income Tax Law, which talks about that if any non-resident employee is coming to India, subject to fulfillment of certain conditions which they have given, and he is spending up to 90 days in a year, then he should not be taxable in India on such income which he is generating, during that period. Another reference which can be drawn is from the OECD commentary. The Article 15 of OECD commentary talks about this exact situation where the employment is exercised in more than the one country, and it also basically it is in conference with the Robert Arthur's case law that a particular country should be benefited out of the out of these ESOP income, and it has to be the basically income generated because of the employee exercising these options, and it should be proportionate to the number of days during which the employment has been exercised in that country. The proportion is number of days spent and where the employment has been exercised to the total number of days during which the employment services are provided for which he is getting the options. So that is the proportion which has to be decided. So these were the two scenarios which we discussed for the scenario 2 where the Indian company is issuing options. Now, what are the other nuances in case of a cross-border, which I will just discuss in next couple of minutes? There can be a timing mismatch in the cross-border ESOPs. Now, what happens is there are different timings in country wise where they can tax a particular income in that country at a different times. For example, take an example that there is a country A where the tax happens only on the sale of the shares of such ESOPs, and country B where, let's say, India, where compensation is also taxed at the time of exercising of these options. So there is a difference. Let's say in year 1 he exercising these options, in year 3 the sale of shares is happening, there is a mismatch of the timing. In such case, there may be a scenario that there can be a double tax scenario. In order to avoid the double tax scenario, the OECD commentary has given that even if there is a timing mismatch, it has to be considered by these countries. However, the domestic laws can be very much complex to get that, and technically also it is very difficult that the income which has already been offered in other country 2 years back, can that credit been taken in the year 3 where I'm offering to tax in the, let's say, resident country. So these scenarios may be challenging in technical life when we file the tax returns in those respective countries of resident and source state. then there can be restriction on the foreign tax credit. In the same scenario where year one I have paid taxes in the source state on the at the exercising event, and in the resident country I have paid the taxes on capital gains in year three, the foreign tax credit which I have paid in year one should be allowed to me in year three as an employee. Otherwise, I'm paying taxes there as well double. So there, and that restrictions can be also there, that how much is the amount to be determined. How can I identify how much is the amount which I can get the foreign tax credit, in this scenario. So there can be nuances on that aspect as well. Then there can be difficulty in determining to which period of services this option relates. This is a very practical issue which we have seen, that how to determine for which period these options are given, whether that has been given for the previous performance, that is given for the coming future performance they are going to give. So it depends on how your ESOP plan and ESOP scheme is drafted. There has to be a contractual arrangement mentioned in such ESOP plan and ESOP scheme, stating that whether this reward is given basis your previous performance, or it is going to be given basis the future performance. So depending on that, this issue can be resolved. The fourth issue is the employment services that are provided in more than one state. Let's say you are providing services in Dubai for 3 months, 4 months in US, and remaining months in India. The nuances will come that when any ESOPs are granted to you from US parent company, whether they are on account of Dubai employment exercised in Dubai, in US, or in India. So there, I think OECD again has mentioned in Article 15 that the allocation rule can be adopted in such case, and all the three countries may get the benefit of this income. Alienation of the stock options as a result of merger or acquisition or replacement of options. In very cases where the corporate structures happens, there may be a case that because there is a stock transfer as a result of this merger. Basically, you are giving up one right to get another right in the resulting company. In such case, if there are substantial changes happens in the rights, can it be treated as a transfer of ESOPs? Whether it will be exempt, those nuances may come, and it depends on your state of residence as well as the source state where the ESOPs have been issued. Also, the conditions which are attached to such rights are very important to be seen in the cross-border structures. Moving to the one illustration, just to give the same case where which we just discussed. I've taken one fact here, that let's take this example to just explain in a better manner. So employee X, who is a resident of country A, he has worked in 7 months in country B. Basically, he is a resident of country A, worked for 7 months in country B. The part of the remuneration that X has derived from his employment in country B was stock options of country Y, company Y, which is also a resident of country B. So basically, he has served 7 months in country B. There is a company based in country B which has issued stock options to such employee X. Now, under the country B law, the employment benefit is resulting from the stock option is taxed when the shares are sold. Just now I gave that example. This is the exact that scenario. And it is deemed to correspond to the difference between the sale price of the shares and the strike price. Basically, it does not take into consideration that you have paid any taxes as on at the exercising event for in any other country. The entire income is generated on the sale price minus if any price is been paid by the employee to gain these stock options or to vest these stock options. So that is the country B law. Now in country A, the employment benefit results, and it corresponds to the exercising event like India, where the difference between the value of the shares on the exercising event and any amount paid by the employee is taxable as compensation. Now, given an example here, the employee X is exercising the option in year one, where he is taxed in country A, and in case he sells those shares, then he is selling those shares in year 3, where the country B is taxing him on these gains as a source state. Year 1, there is a taxability as a compensation in country A. In year 3, the taxability is occurring on the capital gains in the source state. Yes. So the issue arises is whether the country B will levy the tax upon the sale of the shares, and will it consider country A any taxes paid in country A before, prior to 2 years, and how this relief can be granted in such case. So as I discussed, the OECD basically Article 15, Article 23 talks about the scenario, and it does say that technically you can avail the relief from double taxation. Any taxes paid on the income should not be double taxed in such scenario, and that can be availed in year 3, and the remaining taxes after taking the credit should be only paid by such employee to avoid any double taxes. The technically this works, however practically there are many difficulties. As let's take an example of India and US returns. In US works on calendar year basis, India works on financial year basis. Any taxes which are paid by as a foreign tax credit in US, the details of them are only available in the next year, after the completion of the year, once you are filing the returns. So it basically happens that when you are filing the return of India, the majority of the details are not available. There may be a possibility that the foreign tax credit certificate is not available by the time when you are filing return in India. So in such scenarios, it's very difficult practically to assess how much is my foreign tax credit. If you are availing that foreign tax credit, you have to attach the foreign tax credit certificate or some kind of a proof to say that I have paid that much taxes in the other country at certain level. Whether the tax officer will look at that properly, see that whether he can manage to take that the income exactly which has been offered to tax in India, on that income, or less than that something has been paid in USA. All these nuances comes, and normally we have seen that the foreign tax credits are not claimed or given as a claim basically by the tax office, and there is a notices which comes in this scenario. So technically there are issues in these cases, but yeah, one has to look at filing of rectifications, explaining to officers. That may be the scenario which we can cover. Now, I would like to cover the recent judicial, rulings. We have 20 minutes left, so I'll quickly cover this part because the next ruling is, going to take quite a 10 minutes time. So basically, the recent ruling is basis this deductibility of ESOP expenses. Now, what do you mean by ESOP expense? Basically, the discount which is given to the employee as on the date of grant. Basically, let's take an example that the company is granting some ESOP options to employees on day 1. On that day, the fair market value of the company is X. There is a exercising price or predetermined price which is to be paid by the employee, let's say Y. So X minus Y becomes your discount, because at that particular discount, the options are granted to employees on day 1. Now that discount becomes basically your ESOP cost, and that ESOP cost will be depending on whether the employee is fulfilling the conditions over the period of vesting, whether the performance conditions are made, timing conditions are made, the ESOPs are vested, and as on the date of exercising event, basically exact amount of ESOP expenditure can be determined. So this is the scenario of ESOP expenses. Now, the issue which has been dealt in the past and in various cases is whether this ESOP expense, which is a discount, whether it is a capital expenditure or whether it is a revenue expenditure. And there is a ruling of Biocon Limited, Bangalore Tribunal, then it was upheld in 2020 by Karnataka High Court. And recently the SLP was filed by, tax authorities, which has also been, rejected. And now it is in favor of the assessee, basically that the ESOP expense can be treated as a revenue expenditure. The fundamental principles which Biocon has drawn is extremely important to understand. So the ESOP expense, basically, why it is not in the nature of capital expenditure? One can say that it is towards, the shares. Basically, ultimately, the employees are going to get the shares. So it is related to my share capital. So it should be a capital expenditure. But the whole principle of ESOP expenses, why that ESOP expense has been incurred? Whether it is incurred towards your employees, whether you wanted to incur that expenditure towards your share capital, that is a crucial phenomena which has been drawn in Biocon case law. So what it says is basically it is it is basically a payment of salary which you are giving in kind rather than in money. So it is a ascertained liability which is been drawn at first year end when you are giving the grant of options. You know the liability which is going to occur because the discount amount is already fixed and final. So it may be upward and downward scenario depending on how it grows. However, and how the conditions are fulfilled by the employees. However, you know that the liability is going to come. So something is not contingent in nature. So that was the first principle which was drawn. The second is this ESOP discount is basically a substitute of the direct incentive which you could have paid as a bonus or as an incentive to the employees to motivate them to gain their confidence, to promote them to work efficiently and productively in the growth of the business. So this is basically a direct incentive which is given as good as in cash. The third principle which was drawn is that just because one of the modes of compensating employees is in some other form, that does not take away the principle of this revenue expenditure. It's just one of the mode applied towards compensating employees for their services. That's why it should be forming part of their remuneration. The fourth principle which was drawn is if the company does not pay anything to employees, but this incurs obligation to issue the shares at a discounted price on a future date in lieu of their services. Now, this is important. In lieu of their services. So basically, there has to be employment services so that in the future you will get the options. So employment services are considered as compensation, where you pay the compensation towards the employment services. So this is nothing but it has incurred wholly and exclusively towards your business, and that's why it should be deductible expenditure under section 37(1). All the conditions of under section 37(1) has been drawn in Biocon to say that why all conditions are getting satisfied, and that's why it should be deductible expenditure under section 37(1). Now, the employer is allowed to take the deduction here on proportionate basis. So one of the other part which we just discussed, that how the deductibility will occur. The deductibility of such expense should happen over the period of vesting. This is another principle which was drawn in Biocon case law, which was very relevant because you know that this is revenue expenditure, but how to bifurcate over the period of vesting, how much that expenditure is deductible for that year is also been defined in this is also been held in this case law. If there is any adjustment to be made, like true up and true down at the at the event of exercising, the exact discount amount or the exact ESOP amount, so that upward or downward deduction of ESOP expense is of earlier years, when you come to know that, so that is not considered as a prior period. Basically, whenever there is a upward downward deduction of ESOP expense happens in the year in which exercising or there is a lapse of options by the employees, in such cases, in that year, that liability has been occurred or that asset or advance has been occurred. So it should be allowed as a expenditure or income, vice versa, depending on the situation. If there are lapse of options, then there will be a downward deduction. If there are fulfillment of condition, there may be a upward deduction of ESOP expense. In recent case laws of PVR Limited and Shriram City Union Finance Limited, a Biocon case law was referred, and it has been upheld by both the high courts of Delhi and Madras that ESOP expenditure should be treated as a revenue expenditure. So this was one of the major recent ruling, and now it is a settled case law because it has reached to apex court as well. So this was the one of the main principle drawn. The other case law which I would like to discuss, and we have 10 minutes left, so I'll discuss it quickly. Very recently and very interesting case laws which have recently happened. Surprisingly, in this case, The case is exactly same for both the assessees. However, the decision or the ruling which was made by Delhi High Court and Madras High Court, they have given extremely conflicting view in such case. I'll explain the issue and then I'll give the facts and I'll explain how the principles have drawn in both the cases. So basically, the issue is pertaining to that there has been a receipt of discretionary compensation which was paid to employees or the, I would say, ESOP holders prior to exercising stage. So employees have not exercised the shares, but prior to that, there has been a discretionary compensation paid by the holding company because there is a diminution in the value of stock option for such holding company. So there is no contractual arrangement between the holding company and employees to pay such amount. This was a discretionary amount and it has occurred at a pre-exercise stage. So the question arises whether this would be a capital receipt or this would qualify as a perquisite in such cases. Now, in case of Delhi High Court Sanjay Baveja case, it was held that it should be treated as a capital receipt. I'll draw the principles later. And the conflicting view was given in case of a Nishit Kumar Mehta's case that it should be considered as a perquisite. I'll explain the facts in just little small time. So what happens is both of these employees, they are the employees of Flipkart Internet Private Limited, which is an Indian company. It is a wholly owned subsidiary of Flipkart Marketplace Private Limited. And Marketplace Private Limited is a wholly owned subsidiary of Flipkart Private Singapore. Basically, Flipkart Private Limited Singapore has given ESOPs to the step down subsidiaries employees. Okay, so this is the scenario. There was a option plan which was implemented by Flipkart Singapore in 2012, where these employees had given granted options, and part of the options were vested, part of the options were not vested. Now, what happens in 2023? Flipkart Singapore divested its investment from PhonePe business. They sold the basically stake in PhonePe and they divested their business, which resulted in the diminution in the value of the stock options for such Flipkart Singapore. Just to compensate the stock options, and the basically ESOP holders, Flipkart Singapore announced compensation to all the stock option holders. And though there was, as I mentioned, there was no legal or contractual right for such employees to get this compensation as it was not mentioned in the ESOP scheme, but it was given out of the discretionary compensation by Flipkart Singapore. Now, what happened is in both these employees, in these cases, Flipkart announced in advance that they will be withholding tax under Section 192 of the Income Tax Act, and they withheld tax and paid the amount as a compensation. However, both these employees went to tax authorities to get the nil certificate under Section 197. As you are aware, you can get the lower or nil deduction certificate under Section 197 on application. So when they went, in both the cases, the application was rejected. However, the tax authorities, while giving their view, was also given very differently. So in case of Sanjay Baveja, what they have done is the tax authorities said that this should be treated as a perquisite, and that's why there should not be any nil certificate to be given in such scenario. Now, in case of Nishit Kumar Mehta's case, where ultimately the Madras High Court held that it is a perquisite, the tax authorities treated this income as a relinquishment of right to sue the employer. So what they mentioned is the employee is giving up the right or relinquishing its right to sue the employer to get this money, and that's why the Flipkart Singapore has given the discretionary compensation in such case. And then in such case, this relinquishment of right is to be considered as a capital asset, and that's why it should be treated as a capital gains, and thereby rejected 197 certificate again. In both the cases, 197 has been rejected. Now I come to first Sanjay Baveja's case, where the Delhi High Court mentioned that why it is to be treated as a capital receipt and not to be treated as a perquisite, basically. So what major principle they draw is, they draw basic two fundamental principles from the two case laws. The first case law is Saurashtra Cement Limited case. The second case law is on the Godrej and Companies case. In both the cases, what has happened is, in both the cases, it is said that if you are making any one-time payment, which is a voluntarily payment made to employees, because of some contractual, relation or any contractual default, then in such case, such on the basis of change in the contractual terms, if you are making any voluntary payments, it should be treated as a capital receipt and it should not be treated as a revenue receipt. Both these case laws also was referred in the other case law where it was a contrary decision given. However, they referred in very different manner. Now, coming to Sanjay Baveja's case, what has happened is, because it was a one-time voluntarily payment, the High Court drawn basis these case laws and said that it should be capital receipt. It's also drawn may very one fundamental principle that why it should not be treated as a perquisite. So it said that basically perquisite is defined under section 17(2), and how it will be treated as perquisite only if the value of securities or shares are allotted to employees and those are value as on the exercising date. So unless there is an exercising event occurs, it cannot be treated or comes under the purview of perquisite. So this is the essential principle was drawn, that this cannot be treated as perquisite because the discretionary compensation which was paid, it is not linked to the ESOPs because those were not exercised by that time. So that was a major principle which was drawn in Sanjay Baveja's case. And then the court held that it should be treated as a capital receipt. Coming to the Nishit Kumar Mehta's case, where Madras High Court treated this as a perquisite, very fundamental, which was not given in Nishit Kumar cases, how Madras High Court held that it should be treated and it is linked to the compensation. That principle is not drawn. However, what they said is, unless you had the ESOPs or you had the right of getting these ESOPs in the future, you would not have received this compensation. It is given to a ESOP holders. So it is given, and it is given because you are holding that ESOPs. Now, what has happened is, first they draw the principle that the why it is not a capital asset, because this is not a relinquishment of right. The relinquishment of right cannot be treated as a capital asset because there was no right given in the ESOP plan. There was no right given to sue a company if they do not make any compensation at a pre-exercise stage. So that was, the tax authorities' contention was against in that case. Now, right to sue is gone. So what is the other way out is whether right to gain any shares in the future can be treated as a capital asset. So there they have taken the basis of certain case laws stating that in such case also it cannot be treated as a capital asset. Capital asset will occur only if these options are exercised and the shares are allotted. So basically, High Court rejected the contention of both assessee and tax authorities here, and they mentioned that the stock options cannot be treated as a property under the definition of property in section 214 of the Income Tax Act, and the ESOPs are merely rights given in relation to the capital asset which will come in the future aspect. So this was drawn. Now, second is what they mention is how the perquisite comes into the play. They mention that the definition of perquisite under section 17(2) is an inclusive definition. So any discretionary payment which was made towards any diminution in the value of the stockholders should also come under the purview of perquisite definition because it is linked to the ESOP holders, and that's how they drawn that it should be taken as a wider term. It should not be restricted as a expression towards only value of securities. But they also address the problem of valuation because the value of securities can only be occur when you exercise those securities, and the valuation is given under rule 38 of read with 17.2 of in such case what happens, the fair market value as on the exercising date becomes the value, fair market value for the securities. Here the exercising event did not occur, so the valuation was in question. So what Madras High Court held that since the taxpayer did not make any payment towards these ESOPs till the date of getting this compensation, so the entire amount of compensation should be treated as a perquisite and it should be held in the purview of salaries. Surprise to the fact that in both these scenarios and both the cases, they have not dealt in scenario for 56 to 10. So, you know, very ambiguity cases because both are high court case laws, jurisdictional case laws, exactly same facts of the case. However, very different when it comes to the way interpretation of the two definitions, same case laws in two different high courts have taken. So this case, if it goes to the apex court, we would love to hear what Supreme Court takes the decision. But in my view, both the cases have drawn their independent principles, and they say that why it should be a capital receipt and why it should be a perquisite in that nature. So very recent case law, one was held in I think May 2024. Nishit Kumar was in July 2024. Very recent case laws and very important in this manner. One of the practical two issues I'll take and I'll just complete in next 2 minutes. What happens if the employee surrenders the right under ESOPs and receives the payout? In what happens in that case? It just a surrender of right. They have not sold anything. Whether the surrender of right is considered as a capital asset or relinquishment of right is considered as a property under the definition of section 214. So there are various case laws which I have mentioned here. They have taken that call that capital asset which is defined to include the property of any kind is a wider term, and it should the definition of property should cover such scenarios to right to subscribe to the shares of the company. Very surprising. The exact same thing was done in the earlier case which we discussed in Nishit Kumar Mehta and Sanjay Baveja, where they have considered that the property definition should not include right to subscribe to the shares in Nishit Kumar Mehta's case. So, however, there are other case laws which talks about this scenario. So, surrender of right can be considered as a capital asset, and thereby the capital gains, will occur as and when employees surrender the right under the ESOP. So, this is the practical scenario which we have dealt in. Second practical scenario, in case of amalgamation or demerger, what happens? Because as you may be aware, the amalgamation and demerger or merger are the tax neutral in nature under section 47. However, they do not precisely talk about the ESOP holders. They only talk about the shareholders, where the exemption is given to the shareholders. So if there is no specific exemption given to ESOP holders, can we take a view that though not technically but substance over form, it should get covered, and by that nature ESOP holders should also not come under the purview in such cases. However, if you take a broader view, the argument can be placed that the ESOPs are only notional nature and there is no actual capital asset which is getting transferred here. It is just from one company to another company, the same rights are being given, and in such case there should not be any capital gains which should come. Another argument which can be placed that even in such case it should be considered as a transfer and it should be taxable under the purview of 17(2)(6), and taxability of capital gains should not take place in such scenario, because as a ESOP holder you are still providing services as an employment to the company, and that's why you are the ESOP holder and not the basically capital asset holder. So this argument can be placed in both the cases. There are not much case laws to deal with this scenario, but yeah, that's the view. Yeah, I'm completed. Sorry to take a little more time, but happy to answer if any questions are there.
Thank you, ma'am.
I'll stop sharing. Sahil, if you have, are there any questions? Happy to address. We can take just 5 minutes. And
So I think one or two questions we will take.
sure.
So ESOP expenses, which is notional, is allowed as a deduction or not?
So the Biocon ruling has clearly held that ESOP expenditure is not notional in nature, and that's why it should be allowed. If you think that it should be in notional nature and just for the book entry purpose, then it should not be allowed.
Okay. We will take one two question more. So one question from Shubham from Mumbai. TDS to be collected from employees at the time of exercise because there is no cash payout to employee which tax can be withheld.
Sorry, can you please repeat the question? I
So
just couldn't hear.
I think the concerned person is asking about the TDS implicability. What is the implicability of TDS to be collected from employees at the time of exercise, or what is the arrangement?
So at the time of exercising event, the TDS will be deducted under section 192 by the company. In practical scenario where there are cross-border structures, we have seen that the obligation to deduct the TDS can be passed it on from foreign company to Indian subsidiary. So in such case, it will be deducted under section 192.
Okay. So I think majorly we have covered all the questions as well. So thank you very much, SP Singh sir, Rutuja ma'am. As a formal vote of thanks, I thank both of you to present this webinar on behalf of Institute of Chartered Accountants of India. And I appreciate all the members who joined today. I think everyone has enjoyed a lot and has taken something very unique in their knowledge sharing book today. So the topic was is so very well covered by you, ma'am. Thank you once again on behalf of Institute of Chartered Accountants of India. And we'll always look forward for a support, SP Singh sir and ma'am. Thank you very much.
Thank you.